Welcome to the Credit Compass, helping you navigate the world of European credit, where we break down the biggest moves in credit markets, macro trends, and fixed income strategies shaping the financial landscape in Europe and the UK. My name is Gordon Kerr, European macro strategist and host. In today's episode, we will delve into the latest economic survey results released by Bloomberg News and the OECD on the 17th of March 2025. Our focus will encompass the euro area and key economies, Germany, France, Italy, Spain, and the United Kingdom. These insights provide a comprehensive view of the current economic landscape, highlighting both challenges and areas of resilience. The euro area continues to face a complex environment. The European Central Bank has recently adjusted its monetary policy, cutting interest rates for the sixth time since June 2024, bringing the deposit rate to 2.5%. The decision reflects ongoing efforts to balance the decline in inflation and to ensure that sluggish growth can be stimulated enough to avoid a potential recession. The region's economy has struggled to gain momentum, with concerns about potential trade tensions adding to the uncertainty. The Bloomberg survey suggests that the deposit rate will be cut further this year, ending at 2% by the end of the second quarter. Inflation remains the main focal point for policymakers. The ECB projects that price growth will return to its 2% target only in early 2026, slightly better than in the prior survey. This delay underscores the persistent challenges in achieving price stability across the euro area. However, recent discussions surrounding European Commission-supported defense spending and the German government opening of the taps and spending on both defense and infrastructure should also help to support forward-looking growth. But it could also spur inflation. Nonetheless, despite the recent survey responses from the 7th of March to the 13th of March, not many have given the euro area a big uplift to growth targets in 2025 as a result of the recent spending plans. The survey results suggest growth of just 0.9% for the euro area in 2025, 1.2% in 2026, and 1.5% in 2027. The chance of a recession happening is at 30%, only marginally lower than the 32.5% as of the February survey. At a country level, the survey continues to suggest great differentiation amongst economies. Germany, the euro area's largest economy, has experienced a contraction with output falling by 0.2% in recent quarters. This decline is attributed to several factors, including weakened external demand and high energy costs. The survey results expect the German economy to continue to contract in the first quarter by 0.3%, rising afterwards gradually to reach 1.1% in the third quarter of 2026. I know that it does take time for government stimulus to have an impact on economic activity, but I would have expected the German plan to spend to impact the survey results a bit more. Let's see what impact it has next month, but as of now, the view is that there remains a 50% chance of recession over the next 12 months within Germany. Structural issues such as an aging population and a shrinking workforce complicate Germany's growth prospects. These demographic trends pose long-term challenges to productivity and economic expansion, and they are not isolated to Germany. France's economy contracted by 0.1% recently, reflecting broader regional trends. The French government is grappling with fiscal challenges, aiming to balance the need for economic stimulus with fiscal responsibility. Efforts to implement structural reforms are ongoing, targeting improvements in labor market flexibility and competitiveness. Despite the fact that the forecasters expect the risk of recession in France at 57.5%, they do expect that Q1 growth will be at 0.7% year over year and remaining relatively flat until the end of the year. Italy's government has committed to ambitious fiscal targets aiming to reduce public debt levels while fostering economic growth. However, the economy faces headwinds, including sluggish productivity growth and structural inefficiencies. The focus remains on implementing reforms to enhance competitiveness and stimulate investment. The survey suggests growth of 0.4% in the first quarter, rising to 0.8% by the end of the year. It is one region where the economists have reduced their likelihood of recession to 40% from 50% a month ago. Industrial production is expected to lead the recovery from a largely negative rate to positive year-over-year comparisons by the end of the year. Now, in contrast to the still present gloom amongst a number of the largest economies in Europe, Spain has demonstrated resilience in the face of economic challenges. However, recent natural disasters, such as the flooding in Valencia, have necessitated increased public spending, potentially impacting fiscal balances. Nonetheless, Spain's economy continues to show signs of recovery, supported by a robust labor market and steady domestic demand. Spanish GDP is expected to show year-over-year growth of 3% in the first quarter. However, while the prospects for growth are looking positive, albeit very slow for the other economies, they are starting to decline in Spain. Spanish growth is expected to decline to 2% by the early part of 2026. The United Kingdom continues to struggle, particularly post-budget, as concerns surround the prospects for growth. Trade negotiations and adjustments to new regulatory frameworks have introduced both challenges and opportunities. The UK government is hopefully focused on fostering economic growth through strategic investments and trade partnerships in the wake of challenging environments for those trading into the US. However, the prospects for growth still remain challenged with sticky inflation that has proven to tie the hands of the Bank of England. Inflation is expected to continue to rise in the next several quarters, which could keep a floor on further rate cuts. As a result, economists are currently predicting that they will only fall to as low as 3.75% for the Bank of England base rate by the end of the year. This will likely hamper any prospects for an acceleration of growth, which according to the survey is expected to grow only 1%, rising to 1.4% in 2026. Further, the likelihood of a recession is surveyed to be 35%, up from a 25% prospect, according to the view at the end of 2024. Further to the Bloomberg surveys, the OECD outlook was also released, and the outlook for growth has moderated as trade tensions create uncertainty. The OECD economic outlook suggests that their view of many economies, particularly within Europe, will be impacted by the prospects for growth in 2025. They have cut their growth forecast for many European economies by 0.3%, for the Euro area, Germany, and the UK. Italy they cut by 0.2%, and France by 0.1%. The one exception was the increasing growth in Spain, where they have increased it by 0.3% to 2.6% for 2025, in contrast to the declining growth that is expected from the Bloomberg survey. The report cites that consumer confidence has remained weak and policy uncertainty has spiked. As a result, this will impact growth in the first half as businesses try to react to the current trade and policy chaos, and consumers themselves remain uncertain about their own prospects for the future. So what does all this mean for credit? Well, this doesn't really change the rate picture dramatically. The return to a normalized level of rates in the 2% range for Europe and maybe a little elevated 3% plus range for the UK. However, the current economic uncertainty has certainly spooked markets. But those are mainly the arguably overvalued US equity markets. Europe remains a preferred alternative, with European equities still outperforming so far this year, and on the credit side, spreads have not really widened out dramatically, perhaps as credit investors weigh the all-in yields that remain high on a relative basis. As of the 17th of March, the iTraxx crossover index is at 305 basis points and the main index at 56 basis points. These are not even the widest levels for 2025, let alone longer-term wide levels. So in summary, the story for economic growth really remains a challenge for Europe, at least amongst economists. How could we see things developing in Europe in 2025? Given what we are seeing in terms of government stimulus to a struggling market, the risk really does lie to the upside. There are challenges from a trade war with the US, but there is also the prospect to improve relations with those that have been spurned. Added to this, the decrease in conflicts across the globe, or at least the prospect of them decreasing, is a further positive for Europe. The latest economic survey results highlight the euro area grappling with sluggish growth, inflationary challenges, and structural headwinds. Germany and France face contractions, while Italy and Spain strive for fiscal stability amidst adversity. The United Kingdom continues to adapt to its post-Brexit reality, seeking pathways to sustainable growth. Next week, we will look to dig a little deeper and focus on the relative health of the European consumer. That's all for today. Thanks for tuning in to the Credit Compass. Be sure to subscribe for more insights, and we will speak to you all again soon. As always, staying informed is key to navigating these complexities. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.